So, good afternoon, everyone, and welcome to today's webinar on the benefits and pitfalls of buying or merging a solicitor practice with Chris Hutton from Charnwood Accountants and Business Advisors. For those of you who haven't joined our webinars before, my name is Lucy and I'm an assistant consultant at DG Legal. The slides from today's presentation will be sent over tomorrow, and a recording of the webinar will be available for 3 months. So if we do run over and you do need to leave, you'll be able to watch the rest at another time. We are in webinar mode, so we can't see or hear any of you, but today's webinar is a recording, so we will not be able to do a live Q&A at the end. However, if you do have any questions, Chris is happy for you to contact him, and his details will be on the last slide, and they will also be sent to you tomorrow. So by way of a short introduction to Chris, he has been with Charnwood Accountants since it commenced trading in 2004. He is a qualified accountant and business owner with a leadership role in 4 different businesses in different sectors. Chris utilises his experience as an accountant, advisor, and business owner to offer valuable solutions to real-world problems faced by business owners. Chris has a keen interest in succession planning and has personal experience in both buying and selling businesses, having recently acquired a financial services business. So now I'll pass you over.
Good afternoon. Thank you for joining us on this webinar today. My name is Chris Hutton. I'm one of the partners at Charnwood for Solicitors, which is a brand of Charnwood Accountants and Business Advisors LLP. Today we're going to be talking about the benefits and pitfalls of buying or merging a solicitor's practice. But before we get into detail, I'd just like to give you some introduction into myself and the firm. So this webinar is aimed at partners, practice managers, senior solicitors, etc., looking at succession opportunities or for expansion opportunities within their current firms. So if I just give you some background information to us, we formed in 2004 and we started working with solicitors from around that date. At the time, we were a small firm. We only had 4 members of staff, but we've quickly grown and now we form 26 members of staff, most of which are qualified accountants, and they're supported by a team of admin staff. In the early 2000s and then into the 2010s, we were utilising a tax saving model, which as a firm generated in excess of £5 million of tax savings for clients. Unfortunately, that model was closed down by HMRC in 2014, but since then we've continued to expand our portfolio of solicitor clients, helping them to maintain tax efficiency, helping them with profit improvements and succession planning, etc. So over those years, we've built a large number of solicitor clients and we've built up a vast array of specialist services purely for the legal sector. And therefore, we decided to recreate a brand for that called Charnwood for Solicitors, which was born around 2 years ago. Myself, I'm one of the 3 equity partners at Charnwood. I'm supported by Paula Wheatley, who heads up the solicitors department, who some of you may have seen on previous webinars. My main role here at Charnwood is in helping to support business owners, mainly helping to support the equity partners at solicitors practice make commercial decisions to increase their wealth, happiness, and ensure they remain tax efficient. As a business owner myself and an equity partner here at Charnwood, we're in a highly regulated industry similar to you, so I can understand the issues that many of you will be facing on a day-to-day basis. In 2018, myself and my fellow partners here started a new business from scratch called Bytes Accounting, which focuses on the work that we don't do at Charnwood. And in 2021, earlier this year, we acquired a financial services business in Nottingham called Riverfall Financial. So I've lived and breathed through what I'm about to talk to you today about, not just advising it, but I've actually been in the position of buying businesses. So today's webinar will be discussing the matters you need to give consideration to when you're buying into a solicitor's practice, whether that be through acquisition of a third party or through internal succession, or whether you're just planning a merger with another firm. I would just highlight that this webinar is pre-recorded, so I've tried to answer and incorporate the questions received in advance of the presentation, but if you feel I've not answered that question adequately, then my details will be at the end of the presentation, and by all means feel free to pick up the phone or drop me an email and I'll be happy to talk to you. So today's mission is to give everyone some practical and constructive advice to those of you who are considering buying into a practice, and ensure you have the power to ask the right questions of the people that you're buying from, and that's particularly important in early stage discussions. So in today's session, I'm going to be covering three main areas, looking at structure and mechanism, valuation and financing, and some other matters for you to consider. So in terms of the structure, looking at acquisition or merger and what the difference is between them. Then looking at how to structure an entity for tax efficient acquisition, as well as considering the tax position of the seller as well. This is important, as if you can help to reduce the seller's overall tax position, you'll be increasing their wealth, and therefore they're probably more amenable to discussing discounts on the price. We'll also be looking at how to minimise the risks associated with buying another business as well. Then on the valuation and financing section, we'll talk about how much your practice is worth, the changing attitudes of buyers and sellers in recent years, and how could you finance a deal and the associated costs. Other matters we'll consider things like the SRA, client money, insurance, staff contracts, system integration, premises, long-term contracts, and just ensuring you have the budget and the time to dedicate to a process of buying a business. So let's have a look at what the difference between an acquisition and a merger is. A merger is a combination of two or more companies to form a new entity. Due to complexities over regulation in law firms, a true merger is highly unlikely, and there will usually be one dominant party, with a smaller entity being acquired into the larger one in exchange for a percentage of the equity. The dominant party will continue to liaise with the SRA and be the main trading vehicle for the merged entity, and the smaller business is likely to be either liquidated or simply just closed down once it's been merged up into the larger one. An acquisition, on the other hand, is the purchase of another entity by acquiring more than 51% of the share capital or taking over the company's assets. Very, very similar to a merger in law firms, and highly likely that if you are going to do a merger, it will form an acquisition of some sort. So if we just use a simple example, A and B LLP wants to merge with C LLP, becoming A, B and C LLP. A and B is a dominant entity, and that acquires the assets of C. C then takes an exchange of equity for their assets. So whereas A and B LLP might have been a 50-50 partnership before the merger, after the merger, it'll be a 33% split between A, B and C. When we're looking at mergers and acquisitions, historically, there haven't been that many acquisitions amongst law firms, particularly regarding the valuations. Historically, valuations of solicitors have been the value of the current account, and that's pretty much it. However, attitudes are changing in recent years, so acquisitions are more likely. Historically, succession planning has been done from within the firm, so the younger generation will typically take on the older generation's capital in exchange for new equity, and the older generation simply retire with their current account. So let's take a look at how you might structure an acquisition. Now, over the last 15 years or so, many more law firms are structured as limited companies rather than LLPs or partnerships. This is largely to get access to tax advantages that I mentioned earlier. So if you're looking at buying the shares of another company or merging shares into your company, it's important to consider whether you are buying the shares or the assets. The sellers of those shares are likely to want to sell the shares and not the assets because it's advantageous from a capital gains tax point of view. In order for them to obtain business assets disposal relief, or what was formerly known as entrepreneurs relief, they have to sell the shares. The assets in a limited company would trigger potentially a corporation tax gain. Then they could use business asset disposal relief to liquidate the cash within it, but it's still far more tax inefficient than selling the shares. Now, what we have to remember here is that the lifetime allowance for business asset disposal relief is now £1 million. So if the sellers have done a previous incorporation, they may not have this band available. So it's important to understand that position as well. So as a buyer, why wouldn't you just buy the shares? The main issue comes down to risk. We all know that running a law firm is risky business. You've just got to look at your PI premiums to see over recent years how much they've gone up and how risky your sector is. When you're looking to acquire shares, you acquire the history of the business too, the case files, employment issues, disgruntled ex-clients, unknown future mis-selling schemes that might come out in years later. You can, of course, mitigate some of this by undertaking good due diligence and putting various warranties into the SPA. This takes time, effort, and a considerable amount of money. As a buyer, therefore, you're likely to prefer an asset purchase due to its simplicity and risk-free approach. However, the seller will usually try to push up the price due to their tax inefficiency and maintain their walkaway value with the cash in their pocket at the same level as if they were to do a share purchase. So as a buyer, you're more likely to prefer an asset purchase, as I previously mentioned. And many deals we see in the legal sector are structured as asset purchases. So the way this works is your current business will buy the assets and goodwill of the seller. This represents a more flexible approach as the buyer can dictate what is bought. For example, if you have property already and you don't need the extra space, the property lease will be with the selling company, and therefore you don't need to buy this lease into your business because you don't need the space. Long-term contracts, for example, printers, software licenses, etc. The seller may have to liquidate to avoid the contracts, but this is their problem and not yours. Staff contracts are clearly a more complex area, and you would certainly need employment advice in this, but there could be an element of flexibility there. And you could look at doing a partial acquisition. So, for example, if a seller is looking to get rid of their conveyancing department, but your main business is conveyancing, they could sell that conveyancing department to you, and you could add it onto your existing operation. So moving on to how you would structure an acquisition via a management buyout or a management buy-in. So whether the current business is an LLP, a traditional partnership, or a sole trader or limited company, transactions are generally much simpler where the management are acquiring the shares because they already have day-to-day involvement in the operations of the business. So the risks associated with the acquisition are significantly mitigated. The process is therefore very similar to a purchase and can be structured in the same ways, but the documentation can be simpler and the process to go through is much less time intensive because you have already got the background knowledge to the firm and therefore don't require as much due diligence to protect your position. Because you already have that day-to-day knowledge of the business, a share purchase could be an option here. So what's therefore important from your point of view is making sure that that share purchase is done in a tax efficient manner. So the sellers will get capital treatment on the sale of the shares, but if you were to buy them in your personal name, you've got to get that money into your personal name in order to acquire those shares. So what's quite common in this process is to look at setting up a holding company for the management buyout team. That holding company will then acquire the shares of the trading subsidiary business. Because of recent SRA rules surrounding the trading requirements of regulated companies, what would then have to happen is the assets and trade of the newly formed subsidiary business, which was the former trading business, would have to be hived up, so it's now trading from the holding company. This is something that the DG legal team would be able to advise on, and if you are interested in looking at this, then I would be very happy to have a chat with you and work with the DG legal team to ensure a tax efficient approach and a compliant approach as well. So let's now have a look at the tax position for buyers. Corporation tax relief on goodwill, disappeared in the budget in December 2014. This was a major part of the tax savings that I mentioned previously in the £5 million that we'd saved for clients historically. Since 2019, there has been goodwill relief available at 6.5%, but that's only on registered patents, designs, copyrights, etc. So for solicitors, it's very unlikely that you'll qualify for any ongoing tax relief on the acquisition of goodwill. There would be some relief available on any assets purchased as part of a deal, but that would be minimal because the main proportion of the acquisition proceeds would be goodwill. In terms of a share purchase, there's no ongoing tax relief available for a share purchase. And in the long term, the share purchase base price might not have any bearing on future decisions because at the moment there's substantial shareholdings relief available. So if you qualify for that, you wouldn't pay any corporation tax on the share disposal anyway. If you are buying the shares into your personal hands, then the share base cost would reduce any capital gains liability that might fall on a future disposal. If you were to purchase the assets of a business, this would form a base cost for any future asset sale. So as a simple example, you buy a business for £1 million, 100,000 is tangible assets, 900,000 is goodwill. You sold those business assets in 10 years' time for £1.2 million, which is all goodwill. Then you've got a base cost of £900,000, so you will pay corporation tax on the uplift of the £300,000. So after all that, if you're still interested in looking at making this acquisition, how can we minimise the risks associated with the purchase? So from your point of view as a buyer, you should be looking at asset purchases instead of share purchases. The risk can be easily mitigated and you are not inheriting the entire risk of the previous business. Whether you're doing a share purchase or an asset purchase, it's important to undertake a due diligence exercise. The comprehensiveness of that will be dictated to whether it is an asset purchase and what you're buying, or whether it's a share purchase where it has to be all-encompassing. I would also suggest that you're going to live and breathe the target business for at least a month before completing. This is important so you can really get your feet under the table, you can meet the staff, you can assess how good they are, how bad they are, whether you need to think about redundancies or performance management, understand how the files are prepared, look at the systems, the implementation of the systems, whether the staff follow them, and just really get a feel for how that business works. Because after all, in a few months' time, when you've completed that purchase, you're responsible for all of that. Before you acquire the business as well, it's also important to understand the client relationships and where they're born and where the inquiries come from. For example, if you're buying a business where there's 3 partners and 80% of the business comes from the partner's personal contacts, is it really worth paying hundreds of thousands of pounds for those contacts unless you can get them integrated into your way of working quickly and keep that business? I'll just use a quick example. If you've got a commercial property department that is run by one of the partners, which relies on one major construction business who's a golfing buddy of the exiting partner, will that relationship continue after they've retired? So that needs careful thought to consider whether those relationships will continue after the purchase. And if they don't, the price will need looking at to bring it down accordingly. It will be important to appoint a good commercial solicitor, whether you're doing a share purchase or an asset purchase. I know you've all probably studied commercial law at some point, but unless you live and breathe commercial work, I would suggest you don't get involved in the SPA and leave it to the experts. In terms of handover periods with the outgoing sellers, these can be a good thing, where there's difficult client relationships to maintain or high value ones. However, sometimes it can be detrimental, particularly where the buyers are looking to change the business and implement new systems, new strategies, growth plans, etc. Exiting partners can be a bit of a pain, particularly when it's their baby, they've been growing it or working in it for 20, 30 years, and they're likely to disagree with what you're doing. So In terms of handover period, yes, give this consideration, but make sure they're agreed in terms of time sensitiveness. And also, if it doesn't work in the handover period, then you're open to be able to get out of it as well. So hopefully that's given you some understanding of how you might structure an acquisition, either from a share perspective or an asset purchase. On any of these sections, if you want to ask me questions, then my contact details will be at the end. So please feel free to drop me an email or pick up the phone and I'll be happy to help. But I'm now going to move on to a valuation and financing side of things. So in simple terms, business is worth what someone is willing to pay for it and what someone's willing to accept. We prepare lots of business valuations all of the time, but those valuations have to be commercial, because if I value a business that's only worth £200,000 for £1 million, yes, that's great from the seller's point of view to go out to market and say, well, I've got this business worth £1 million. But if someone's only willing to pay £200,000, you're never going to sell it. So it's looking at the balance in terms of what someone will pay and what someone will accept. 20 years ago, in law practices, selling a business was virtually unheard of, as it was all deemed to be personal goodwill of the partners, and therefore there was no third-party value. However, attitudes have changed in recent years, and we've all seen the press for firms changing hands for in excess of £1 million for relatively small firms. And it really comes down to how those firms are managed, the exceptional profits generated, the team, etc., to whether your business has commercial goodwill that's available for sale or it doesn't. And I'll look at some of that in more detail. So when we look at how to value a solicitor's practice, it really depends on the circumstances. And the most important one of those is what aspects of law does practice undertake. And particularly if they've got recurring income sources, such as employment advice contracts, where there's a guaranteed future income to those contracts, or LEA contract awards, which again have a certain element of guaranteed value to them, albeit we all know the returns on those contracts can be mitigating against generating a significant profit. You also have to look at the personal goodwill in the business. So if you're looking at a sole trader business that makes £100,000 per year, all of that £100,000 is the partner's salary, and therefore the goodwill in that brand is fairly minimal. It's important to look at what the stake is for. So if you're buying 100% of the business or even a controlling stake, that's more value than a minority interest. So if you're a fourth partner coming into a three partner firm and you're only taking a 10% stake of the equity, that's going to have fairly minimal goodwill value. One of the most important aspects to look at is a reputation. So looking at the company's PR, its reviews, its social media availability, its generating income resources from recommendations, etc. That's all going to help in building the value of the business. Another thing is looking at who generates the income. Is it the staff or the partners? If you've got the partners generating 90% of the income and the staff doing it, what's going to happen when those partners leave? Whereas if you've got 2 or 3 partners, but 20 staff, and the partners are there developing the business and the practices, and the staff are all out winning the work, that has a significant value to the multiples that you're going to get when you look at selling your business. Or even buying it, you can expect to pay a lot more for a business that the income is generated by the staff and not the partners. So when we take account all of the things mentioned on the previous slide, and we look at valuing a third-party acquisition, this is a recent case that we were involved with. So it was a multidisciplinary practice, but no conveyancing. It was set up as a limited company with 1 equity owner and then 1 employed director. The turnover was around £1 million. The profit generated was around 350,000. We valued the business at a 3 times a multiple of adjusted profit, which was taking off £100,000 to represent the replacement partner's salary. So we're looking at exceptional profits for the business, of course, for £1 million. A 3 to 4 times multiple of that is 750,000 to £1 million placed on the goodwill. The business did end up selling for within those parameters. In this particular deal, the SPA was written up as though the buyer was entitled to the excess cash in the business at the deal date as well. So that had built up significantly, and they exited with around £1.5 million, which was done as a share sale because the due diligence was undertaken and the risk factor was very low. And therefore, the seller had a very good deal from it. In this particular deal, it was done through some upfront consideration, 25%, and then the balance of the consideration was payable over 3 years. The seller agreed a consultancy agreement with the buyers, and this was partially funding their retirement. So with the consultancy agreement and the consideration, this was a significant boost to their retirement pot. For the buyer, this was another local firm, although slightly bigger than the seller. They got a great staff force to come and work for them because they were struggling with recruitment, and they got a very successful business with an element of a recurring income stream within it. So everyone was very happy, and the 75% that was being paid over 3 years was entirely being funded from the profits of the business. So from the buyer's point of view, their capital outlay was the initial £250,000, and the remainder was funded from working capital in the next 3 years. So from their point of view, they get a business turning over £1 million, making £350,000 of profit that they only paid £250,000 for, and in 4 years, they're debt-free from the process. So this is what's called a vendor financed acquisition, and it's very, very common nowadays. So if you're looking at acquiring a third party, it's highly likely that something along these lines might be the best way forward. Now, if we look at a management buyout or a management buy-in, similar principles to the valuation are likely to apply. However, it might be that there's a discount agreed due to the loyalty and the generation of profits over the years by the up-and-coming partners. Now, when we did an MBO here in 2017, that was certainly the case. However, some partners can have differing views on how they need to exit, and if they haven't planned for their retirement particularly well, they might have an element of greed and look at getting funds out of the business that's far beyond what it's worth. And that comes with issues surrounding loyalty of the staff as to whether you want to do an MBO for a higher price because it's what you know, or you either look at setting up your own practice or moving to a firm that might be offering an MBO in, say, 4 or 5 years. So all things to consider. What's quite common in management buyouts is an anti-embarrassment clause. So say, for example, a discount of 40% is agreed on the commercial price of it, but you go out to market and sell the business for full commercial price in a year's time. An anti-embarrassment clause would mean some of the uplift is payable to the outgoing sellers. This is becoming more and more common in share and asset purchases as the values in law firms do increase. In addition to the valuation of goodwill that would be paid out on a management buyout, the sellers are likely to expect the full value of the assets to be taken out. So that would be their current accounts or reserves in a share acquisition. So you've got to a position where you're looking at making an offer to someone and acquiring their business, either through MBO, share purchase or asset purchase. How do you finance that deal? Now, very few deals nowadays are for cash on completion, and that's across all sectors, not just solicitors. What's commonly used as a phrase is a vendor finance deal. And what that means is that the purchase of the business is funded through future profits or the capital within the business. For solicitors firms, it does mean you're likely to put your hands in your pockets at day one to fund some of the initial consideration, but after that, it should be funded through the ongoing profits of that business. So let's say there's a deal at £800,000 plus net assets on completion of £100,000. On completion, it's agreed that 25% of the goodwill consideration, i.e. £200,000 plus the assets of £100,000 will be paid. You're going to need to find that £300,000 from somewhere. Then there would be deferred consideration payable over 3 years at £200,000 per annum. If we're looking at a deal like this, the business should be making over £200,000 of profit, and therefore the deferred amounts can be funded from those profits generated. If we look at the initial £300,000, where is that going to come from? Some of it would come from cash in the business. It's likely, and it's common in SPAs, that an element of working capital is retained for the acquirers. The balance is likely to come from a bank. Now, at current, the high street banks have lent out so much money in bounce back loans and the CBILS loans that they're unlikely to finance a deal unless there is external security available, for example, a business or personal excess property. Most banks won't touch your principal residence property. Therefore, you're probably looking at second-tier lenders who are likely to be interested, for example, Funding Circle, Aldermore, Oak North, etc. These do have a typical rate of borrowing at around 8% plus a 4% front-loaded fee. But if you look at the rate of return on an acquisition, and say you're paying £800,000 for a business that's making £250,000, you'll get a return on investment of in excess of 30%. An 8% borrowing rate isn't too bad. And then you've got that profit from year 4 onwards that is entirely yours. What's important when you're looking at borrowing is that you draw long-term cash flows to ensure the model is affordable and sustainable. And this is something we can help you with if you need us to. So now let's move on to some other matters to consider. One thing that I get from speaking to lots of people that have bought businesses is talking about the amount of time it takes to commit to an acquisition. And speaking from personal experience here, it will destroy your personal time. There is no doubt about it. So before you go on the acquisition trail, make sure that you have all of your ducks in a row to be able to take time out from your chargeable time and your day-to-day role to dedicate to this. This is especially important if you're in a multi-partner practice and you haven't got the staff to lean on, and so you're leaning on your other partners. If you don't get the buy-in from all partners and one person can't step away in order to progress with the acquisition, then animosity is going to rise fairly quickly amongst the other partners who they might feel they're carrying you, but in fact, they are just contributing to the success of the practice by allowing you the time to lead with this venture in order to proceed with the acquisition. The other thing to consider is that most acquisitions don't succeed. So from my experience, it has less than a 50% success rate. So the time that you're investing in due diligence and spending time with the business that you're buying is likely to be lost time. So before you set out on the acquisition venture, it is very important to ensure you've got the buy-in from all partners and the time available to commit to it. Along with the extra time, you've also got to think about the extra cost of acquisition. So along with the legal fees, the due diligence, the financing costs, there is also possible run-off insurance as well. It's something that gets missed quite often in discussions. Who is going to pay that run-off, or are the client files going to be integrated into the current acquiring firm's policy? Now, that's a decision and a discussion to get agreed with the sellers as soon as possible, because it is something that does get contentious later down the line. In addition, with the formal costs of running the business, you've also got to consider the costs after you've acquired it. So things like extra license fees for the new staff, systems integration, upgrading hardware for IT purposes. Many firms that go on the acquisition trail will buy businesses that have had a lack of investment in them. So if you've got a retiring partner or a firm that is very old school, you might be buying a business where the laptops are 10 years old. To get them up to current date, if you've got 20 staff, you're looking at 25 grand investment in IT. So all of that needs factoring in and building into the cash flows. Another thing to think about is, what if things go wrong? So you buy a business with some deferred consideration and performance of that business isn't as expected, and it's not sufficient to generate the funds to meet the commitment of deferred consideration. What do? You need to make sure you've got a backup plan, and when you're focusing your numbers, you need to have a best case, an average, and a worst case scenario. So even under a worst case scenario, you can still meet the commitment that you've entered into. it's highly likely that if you borrowed funds from a second-tier lender in order to finance the acquisition, that you probably got a personal guarantee on that financing. And the last thing you want is to have to put personal assets and cash up to fund the business costs. So having a contingency plan for worst case scenarios is very important. Mentioned it before, insurance, it's very important to understand who the risk is with in relation to historic files and who is bearing the cost of that. So that's a conversation to get out of the way very early because, like I say, it can get contentious. One of the most important factors to consider in any acquisition or merger is how you're going to deal with the SRA. So you must deal with them on any change of control. We work with DG Legal with most of our clients, and their service is always exceptional. So for guidance on this, would highly recommend their services. And then in respect of client money, you need to ensure that client money is protected at all times and that clients are communicated with. And again, this is something that Paul and my colleague can help with, and the team at DG Legal can assist with in dealing with client money issues. There's going to be lots more issues to consider. This is just a short snapshot of them. And if you've got anything you want to discuss or go through with me, then by all means do feel free to contact me. At the start of this seminar, I did promise you a webinar on the benefits and pitfalls of acquisitions or mergers. So I've just summarised those into a quick summary. And these are just a rough overview of some of the things to consider. So from a benefits and opportunities point of view, the obvious one is you're going to expand the business and generate extra income generating capabilities. For a lot of firms, there's potentially economies of scale to be obtained. Now this can come in combining costs. So if we look at the costs of running solicitors, the overheads are significant. Think about your library costs, your subscriptions, your IT licenses, your rent, your rates, your telephones, etc. By combining two businesses, you can get economies of scale and generate exceptional profits. If you want to look back at a webinar that my colleague Paula hosted about benchmarking your practice, that talks about ways you can improve your profitability. So it's worth checking that out to get some ideas on that side of things. For many businesses, amongst our client base, one of the biggest issues that they've faced over the last 3 to 5 years is finding new staff. It's become incredibly difficult. Recruitment agents are charging a lot of money to get access to a staff base. So by acquiring, you can get access to new qualified staff and a service offering in different departments, etc., that can expand your existing complement. And touching on that, if you're looking at acquisition, you can expand your service offering. So, for example, I've got a client that is pure commercial solicitors. If they wanted to expand their service offering, they could go into personal services such as IHT planning, will drafting, trusts, etc. For MBO teams, it's an opportunity to uncap their earnings potential and take control. So what I mean by that is an MBO team is highly likely to be on a salary at current. That salary could be linked to performance of the business. It could be a fixed rate, but it's highly likely to be less than £100,000 per year. For most equity partners in the solicitor's practice, we would be expecting you to all be earning more than £100,000 a year if you run an efficient business. So for an MBO team, it's unlocking that earnings potential, taking you away from a salary and putting you in control to take a reward for the work you're doing in driving that business forward. And yes, it is going to cost you some money, and you are restricting your earnings capacity for 4 or 5 years whilst you buy that potential. But after those 5 years, the debt is all paid off. You've unlocked the potential and your earnings capacity is uncapped. Something else to consider is businesses that are looking at acquisitions are generally forward-thinking, modern businesses. And it's bringing that energy into an old-fashioned business can get new buy-in from older staff, and it can increase the benefits to the business and help it go forward. So bringing new life into the business, basically. In looking at drawbacks, complications of buying or merging a business, time is a big one. You are going to spend a lot of time in first acquiring the business and secondly integrating that business. The next two are all risk-based. So you've got the business risk associated with client files, for example. You might not know everything that you're acquiring. And then you've got the financial risk. So if you've got deferred consideration, it's making sure that you can pay the debt associated with buying that business. Insurance will be a complication, and it's going to be working with your brokers and the seller's brokers to ensure that that's taken care of and that both parties are protected. Another complication that's going to come into play is that corporation tax is increasing to 25% for many businesses in 2023. So when you're looking at the numbers, factor that in, because that is going to reduce your take-home pay or the capabilities of the earnings of the business from buying other practices. And then compliance, you will have to get the SRA involved in the process, and managing the client money transition will be time consuming. So ensure that is factored into the situation. So that's the end of my content. This seminar is pre-recorded, and I have had one question coming in advance, which is someone has asked about buying into the business and buying around 30% of the business into a existing family business. Unfortunately, there's not too much detail in that question, so I've not been able to tailor a specific response to it. But if the person who wrote that does want to contact me from the information coming up with my personal details, then by all means, please feel free to give me a call and I'll be able to talk through that in more details. I need some information surrounding the structure of the firm. Is it a limited company? Is it an LLP, partnership, etc., before I can give some specific advice on that. So please do contact me. If anyone does have any questions, my contact details will be left on the last slide for a minute or two for you to write them down, and then get in contact with me after that, and I'll be happy to spend some time talking to you and going through any issues you've got. So a little bit of a shameless plug on our part. So we are looking to grow our solicitors department. We do love working with solicitors because of the similarities in what we do. We're a professional services business. We sell time, we employ staff. We have very similar trading principles to solicitors do, and therefore we feel we've got a lot that we can bring to the party in terms of helping you. We think we're very good at it, but don't take a word for it. If you have a look at our website, there are some testimonials on there and reviews. You can have a look and get in contact with us. And there's a special offer if anyone after this meeting wants to have a free 2-hour meeting. Quite happy to discuss your business structure, profit-making opportunities, succession, acquisition, etc. And quite happy to spend 2 hours of our time talking through how we might be able to help and ways that you can improve your business. If you want to take us up on that, please just drop me an email after the seminar and we'll get something booked in. And finally, we also work with many solicitors, third-party tax specialists. So things like capital gains tax reports in divorce and estate cases. With the 30-day CGT reporting on second properties, we can do that for non-clients of ourselves. Business valuations for disputes. We have a retainer service for some firms for ongoing inheritance tax, trust advice, etc. For corporate departments, we can assist in tax planning for your corporate clients, and we can assist in tax planning in complex trust and IHT matters. So if you currently don't have a third-party advisor and are looking for referral sourcing, that would be delighted to have a chat with you on it. So as I promised, here's my contact details. I'm just going to leave them up for a minute or two before I end the seminar. I'd like to thank everyone for listening, and like I say, if anyone has got any questions or comments, I'd be grateful to hear them and would love to get in contact with you. I believe there'll be some feedback coming around to get some feedback on this. I'd appreciate any honest feedback, whether positive or negative.
So that concludes today's webinar. Thank you everyone for joining us. As a reminder, the slides and a recording of this webinar will be sent over tomorrow. This afternoon, you should receive an email, as Chris was saying, asking you to rate us out of 5 stars. So if you have enjoyed, please do leave feedback, and we also encourage suggestions for future topics for different webinars. So our series of webinars continues on the 2nd of September, and we will be presenting on procedural fairness and disclosure for immigration lawyers with Raphael Jazarum and Ellis Wilford from the 36 group. Thank you all for watching, and I hope you have a pleasant afternoon.